Good afternoon and welcome to this webinar on how to do a firm-wide risk assessment. I'm Zoe Allen Robinson. I manage the AML Proactive Supervision team at the SRA, and I'm pleased to chair today's discussion and feed in practical tips on ensuring a compliant firm-wide risk assessment. I'm joined by my colleague Michelle Clement, AML Associate in the team, and she is responsible for conducting inspections at law firms, assessing their AML compliance, and has seen a significant number of firm-wide risk assessments as part of her inspections, so is well placed to share her insights with us today. This webinar is aimed at money laundering compliance officers and those responsible for AML compliance at law firms. There is a link below that you can use to submit questions to us during the webinar, which you can do on an anonymous basis if you wish, and we would encourage you to ask any questions you may have in this area, and we'll pick those up at the end. So in terms of what we're going to cover today, the requirement to do a firm-wide risk assessment is set out in Regulation 18, and this came into force in June 2017 and was a new requirement. And since then, we've produced a warning notice, guidance, template and checklist to assist firms in complying. Failure to have one or significant delay in putting one in place would be referred to our AML investigations team, which can result in a sanction. Our last AML annual review, published last year, found that firms were still struggling to get this requirement right, with only 38 of the 98 assessed as compliant and 50 requiring corrective action. 10 firms were referred out of that batch. Regulation 18 requires all firms to have a firm-wide risk assessment, regardless of your size or nature. And there are 5 key elements that you can see on the screen there, which Michelle and I will go through in turn today and give some practical tips. When drafting this document, you have to consider our sectoral risk assessment and what we've identified as higher risk, and if this applies to your firm. You also should set out how you have assessed each individual risk factor and your conclusion on risk by providing a rating. This can feed into individual matter and client risk assessments. It's a key document as it sets out your firm's risk assessment. It requires you to have a knowledge of your client's services and how you work, and an assessment of the risk these pose. It also sets out what is out of the ordinary for a firm and what you tolerate. So I'm going to hand over to Michelle now, who's going to take us through the first risk factor you need to consider.
Thank you, Zoe. So I'm going to start by providing you with information on how to adequately assess customer risks, which I will be referring to as client risks throughout this webinar. So your assessment should focus on the types of clients that typically instruct your firm. Are they individuals or companies? How familiar are you with your client's usual patterns of business? So just as an example, if you have an existing client that has purchased 2 residential properties over the years, let's say maybe the first was for £250,000 and then they want to upscale a few years later and they instructed you to assist them in the second purchase for £400,000. A few years later, they want to move again and they instruct you in the purchase of a property for £1 million. Would your staff be alert to the fact that this seems to be out of the ordinary for that particular client? You also need to consider whether the clients that you deal with are repeat clients. Are they long-standing clients? The clients that you've dealt with for generations, are they walk-in clients? Do you have a reciprocal agreement with any organizations or referral agreements with estate agents, for example? So as you can see, it's important that you establish who your clients are. Once you've got that down, then it's important to look at the money laundering risks in relation to those clients. So you should be describing any factors which make them a higher risk for money laundering purposes. So are they politically exposed persons? Are they high net worth individuals? Are they cash intensive businesses, or do they run a cash intensive business? So we're talking things like hair salons, barbers, nail bars, restaurants, just to name a few. When assessing client risk, you should also consider if your clients have any links to any high-risk jurisdictions or any sanctioned jurisdictions, which Zoe is going to touch on in a moment. Are any of your clients designated persons or entities? And designated persons or entities are those who have been sanctioned by the government. Do you have a process in place to identify politically exposed persons and designated persons? These should be included in your firm-wide risk assessment. You should also consider if you receive instructions from a third party. So is this for a genuine reason, or is the client just trying to remain anonymous? We recognise that in some circumstances, some clients don't have standard documentation. So your firm-wide risk assessment needs to detail when this would be appropriate and when you would be willing to tolerate that. If you have clients that are companies, you should also consider describing the ownership and control structures that you typically encounter. And it's advisable to actually describe any extraordinary exceptions. So, for example, if you're a firm that's accustomed to dealing with small limited companies, but you have maybe one large firm that has a complex structure, your firm-wide risk assessment should also detail that and also the risks associated with having them as a client. A good assessment of client risk will support you in producing an effective client risk assessment, which will help you identify any unusual transactions and how to spot changes in the client's usual activity. I'm going to hand you back over to Zoe now to go through geographic risk.
Thanks, Michelle. So here you should consider where you have your offices and where you offer services to. So, for example, is it in a high crime area? Do your clients come from the local area, or do they have links to other areas nationally or internationally? And this should be set out in your firm-wide risk assessment, assessing each area. Where you have multiple offices are the different risks for offices because of those geographical locations, which ties into some of what Michelle was saying on client risk. For example, if you have one office in a very rural area that deals with agricultural businesses that are cash intensive versus potentially having a client base in London where the typical value of a transaction is considerably higher than your other offices, and assessing that based on those geographical locations. It's also important to note the requirements in the regulations, and in particular Regulation 33, which requires firms to apply enhanced due diligence measures in circumstances where there's a person established in a high-risk third country, or in relation to any relevant transaction where either of the parties to the transaction is established in a high-risk third country. So it's even more important to consider where your clients are, client entities, and the transactions you are working on are based and where they're linked to. And when considering geographic risk, this isn't just limited to those jurisdictions that are listed as high-risk third countries, which you can find in Schedule 3ZA of the money laundering regulations. It's no longer the EC list after we've left the EU. You should also have regards to other credible independent sources when determining what is a high-risk country for your business. So, for example, looking at sources like Transparency International, Basel or FATF lists, or a combination of those for you to determine country risk. And it's good practice to have a system that can identify high-risk countries, which doesn't need manually updating. And this is because fee earners can then assess easily, have we got a client that's based in a mandatory country? Have we got a client based in a country that's not within our tolerance range? And then they know whether to do enhanced due diligence or to refer that to you or the MLCO to say, should we be accepting this client's instructions? You should also consider any geographic risk relating to the origin of the funds in transactions, like evasion of currency controls, for example, funds from China, and the risk of shadow banking. So include consideration of where your clients, client entities, or the transactions you're working on are based and where they're linked to, and assess for each of those areas whether it's usual practice and what your tolerance is. And I'm going to hand back to Michelle now, who'll talk a bit more about product and service risk.
Thank you, Zoe. So this is actually a risk factor that firms struggle to get right. I've seen a number of firm-wide risk assessments that don't address all the services that the firm provides. So I just wanted to let you know that we actually do check against your firm-wide risk assessment the services you provide when we inspect your firm. So it's very important that your firm-wide risk assessment risk assesses each product and service that you provide, as well as looking at how risky those activities are. So put simply, this section should describe each service you offer within each area of law and assess the level of risk associated in that area of law. So you should also document if your staff actually ever go outside of any main practice areas. So do they do one-off favors for specific clients? For example, are there any risks associated with them doing that? So I'm also aware that some firms speak with heads of departments to get department-specific information, and that often results in a tailored risk assessment. So if you have different departments in your firm, this is something that you can consider doing. In order to evidence that you've actually assessed the risk, it would be helpful to rate the risk for each work area. So these ratings can then be practically applied by fee earners when determining the level of due diligence to apply in each matter. Another element to consider when looking at this risk factor is the interaction between work that's regulated under the money laundering regulations and work that isn't regulated. So I'll give you an example. In a personal injury claim, that wouldn't fall in scope of the money laundering regulations. However, if damages were to be awarded and then to be held on trust, that would bring the matter into scope of the money laundering regulations. So it is very important that you assess the correlation between any work in scope and any work not in scope. And back to you, Zoe, to go through transaction risk.
Thanks, Michelle. So in terms of transaction risk, as Michelle just highlighted with products and services, this is another area that firms tend to struggle with and they're not quite getting right. So of the 45 firm-wide risk assessments we reviewed as part of a wider anti-money laundering desk-based review, we found over half had failed to consider transaction risk. So really significant number there. So in terms of approaching this area and how to assess it, you need to think about the types of transactions your firm deal with. So, for example, buying and selling property or transferring funds, and also include non-monetary transactions such as the transfer of shares or property. And it's good practice to describe the size and frequency of the transactions that your firm deal with. So is the size of that transaction high risk of itself, or what would be considered higher value or frequency for your firm in those areas? And transaction risk is also covered in Regulation 33 of the money laundering regulations, where it sets out some very specific areas that are determined higher risk and require enhanced due diligence. So it's required where a transaction is considered complex or unusually large. So again, in this area, it would be good for it to set out, what types of transactions you deal with. Are they considered complex? What is complex for your firm and what would be considered unusually large in those areas of transactions. And that would also tie into what Michelle was talking about earlier, which is, what is normal practice to that client. You also want to consider, are there any cross-border transactions and what are the risks associated with such transactions? Do you accept any other currency? For example, cryptocurrency we know is sort of emerging now, and it's good practice to evaluate the risk this may present. And are there adequate safeguards around your client account, which we know in transactional work is used by money launderers to try and give that veil of legitimacy. So it's good practice to acknowledge any training undertaken by account staff and the screening that you've done if you wish to include controls in that document or mitigation. And do you have a process to deal with unsolicited payments? And if not, you should. I mean, obviously, the guidance we give here is that you really shouldn't be giving out client account details unless absolutely necessary, and try to avoid the risk of needing to submit a suspicious activity report. And finally, also, you need to consider, do you deal with transactions that may facilitate anonymity? So, for example, certain trust or company formation. If so, it's good practice to describe the service areas, which might remove identifying details from a beneficial owner, payer or payee, and why that risk is tolerated and considered acceptable and not a flag for your business. And I'll hand back to you, Michelle, now for the final risk factor.
Thank you, Zoe. Okay, so on delivery channels, when assessing delivery channels, you need to identify the various channels that you use to provide services to your clients, particularly to remote clients. This is another area where firms don't tend to get it right quite often. And a good place to start is by describing the ways in which you deal with your clients. So do you meet all your clients face to face? You speak to them on the telephone, emails, Zoom, Teams, whatever you use, but you need to evaluate the risks that these represent in practice. So delivery channel risk is not only about whether you see the client in person or not. This can include things like whether you receive instructions from third parties. So for a larger firm, that might be from family offices if you're dealing with those. And for a smaller firm, it could be if you're dealing with your client's relations. So how do you ensure that the instructions are genuine? And also, how do you ensure that the person that's instructing you has the authority to do so? Your firm-wide risk assessment should set these out. Your firm-wide risk assessment should also reflect on whether you actually send or receive funds from any third parties. When would it be appropriate to do so? And are there any risks associated with doing that? Your firm-wide risk assessment should also address any new business practices or technology that you've recently adopted in your firm, and what are the risks of doing that once again. If you have multiple offices, you should review your exposure to passporting. So we reference this in our sectoral risk assessment. And this is where a client instructs a firm on a low risk matter to avoid scrutiny later. So for example, if you have two offices and the client instructs the one firm to assist with drafting a will, but then they contact the other office to assist with a conveyancing matter months down the line in the hope that no checks are going to be conducted because they've already instructed the other firm. Do you have processes in place to make sure that all the checks are conducted at the right time? Okay, so that's it for the delivery channel risks. We're going to be moving on to some hints and tips now. Having reviewed hundreds of firm-wide risk assessments, we have come up with some hints and tips that we hope will help you, which I'll be sharing with you now. So the first thing is that a firm-wide risk assessment must be easily identifiable. So the LSAG guidance is very clear that it must be a distinct, separate document. So I've seen situations where firm-wide risk assessments are incorporated into a policy, as an example, and it can be very difficult to actually identify where the firm-wide risk assessment starts and ends. And if that's the same for me, it's going to be the same for your staff. The second thing is we consider it good practice where firm-wide risk assessment actually details the methodology that's been used in preparing the document. So as previously mentioned, this could be if you'd spoken to heads of departments, if you reviewed guidance such as the National Risk Assessment, if you looked at the LSAG guidance, Legal Sector Affinity Group guidance, or our sectoral risk assessment, your firm-wide risk assessment should detail that information. A good firm-wide risk assessment should state the risks which the firm is exposed to with reference to each risk factor. But not only that, you should actually expand on the risks you've identified. So for example, as we said before, what is usual for the firm, what is considered unusual. Every section should clearly demonstrate that you took some time to consider everything. This means that if you're using a template, you must not completely rely on a standardized text or any pre-populated tick boxes. So if there is anything that doesn't apply to your firm, and you can say not applicable, but please do explain why that's not applicable to your firm. A good firm-wide risk assessment should tell the reader what the firm does and not what the firm doesn't do, which we see quite often. So if there's any information that is relevant to your firm that is not contained on a template that you might be using, please do include that. So the next tip is actually a reminder that your firm-wide risk assessment is a living document, and you should review it regularly to make sure that the risk that you've identified before remains accurate, and also to identify any emerging risks. So it's also important that you review it to make sure that it doesn't contain any out-of-date references, which we see quite often. It probably goes without saying that the firm-wide risk assessment should be signed and dated by the responsible person, so there will be no confusion in the future about when it was last reviewed. It's also important to retain copies of any previous firm-wide risk assessments so you can demonstrate continued compliance, but this will also allow you to review the risks you previously identified to see if they're still present. If a decision is made that the risk no longer exists, then you should also document that on your firm-wide risk assessment. If you choose to rate the risks, please keep the terminology simple. So low, medium or high, or 1, 2, 3, 1 perhaps being the highest and 3 being the lowest, that would be sufficient. There is no need for overcomplicated weighting matrix. You should also check if you agree with any pre-populated risk ratings on templates. And if you don't agree, then you should include information which tailors it to your firm. The final hint I have for you: Some firms choose to set out the inherent risk that they've identified, while some firms choose to set out the inherent risk that they've identified, how they mitigate those risks, and then the residual risks. It's completely up to you how you wish to do so. I'll now hand over back to you, Zoe, for questions.
Thanks, Michelle. And I think on the inherent risk or mitigated risk, it's important, whichever you choose, it's clear from the document. So we know why. And actually, then when you're looking at files, it's also good for you to know that, because when you're doing your checking compliance with the regulations, you know, have they applied those mitigations that you mentioned in the firm-wide risk assessment. So just an add on to that. But also to flag really now that we have got a number of resources available for you in this area. Michelle and I have touched upon a number as we talk through in terms of the sectoral risk assessment and warning notice, and we will make sure the ones that we've mentioned are available on the events page alongside the slides. If you have a really case-specific issue that's potentially a live issue with a matter or a client, then you can also call or contact our professional ethics helpline to give you some guidance there of what to consider. So we will crack on with some questions. So I'll pose this one to you first, Michelle. So this is about, can I use a template, or more, they've also said, should I use one, essentially, and is there anything you'd advise around that? I know you touched upon it briefly earlier.
Sure. So, I mean, this is a question we get asked quite often. And the short answer is it's actually up to you. So we don't object to firms using templates for their firm-wide risk assessment. What we have found is that most firm-wide risk assessments on templates are not usually very tailored. So there's a reliance on the standard text, and it doesn't really speak to the risks specific to your firm. So what I would suggest is, if you do want to use one, please make sure you tailor it, and you make sure that the information that's on the template is applicable to the circumstances in your firm. I have seen some very good firm-wide risk assessments that have been they've used a template for it. So we don't object to it. We have one ourselves, but as long as it speaks to the 5 risk factors set out in Regulation 18 in enough detail, and it's suitable to the size and nature of your firm, you should do, if you want to.
Thanks, Michelle. And it can be that really helpful starting point for firms, can't it? And I think the other thing we've noticed, that do be mindful if you use a template and it says at the beginning, a checklist of things that you've considered, we may ask to see those things. So do check that you have actually considered file reviews or meetings with your board, or do be mindful of what the template says and what you've actually done. Had a really good question in around our slide talking about links to high risk countries, and whether this is different for being established or based in, and what if, the example is, what if someone's born in a high risk country and has a background in it, but is now working in a non risk country. So I mean, my first thoughts on this is that we need to be really mindful that, we're not discriminating against people because of their nationality, for example. And it's a really good point about that difference there with established in. An example I can give as to why we talk about links is if someone is from a country that's higher risk, or where there's several sanctions like what we're seeing at the moment with Russia and Ukraine, and their family members who are still there are providing funds for a transaction or a gift, or you can see the money's coming from accounts there. That's what we mean by links, and you need to probably take a wider holistic approach to country risk there. But it would not be, as this person's asked, sort of just by the fact they're born there, that would mean it's enhanced due diligence, or you shouldn't be acting for that client. So really good question there. So Michelle, is the expectation for fee earners that they would look at the firm-wide risk assessment each time they matter risk assess, or that they should have read this document more generally?
So that's a really good question, actually. And I think there are probably 2 points that I'd like to pick up from there. So starting with the regulations. So Regulation 28 sets out that the extent of the due diligence measures in any particular case must reflect your firm-wide risk assessment, and of course your assessment of the level of risk in any particular case. Well, I think this highlights that the fee earner must actually know what the firm-wide risk assessment says to be able to reflect that in any particular case. So to me, I feel like if the fee earner is being trained and they're regularly trained, they know what the firm-wide risk assessment says. They can understand what the firm's appetite for risk is. Not to sound like a broken record, they know what's usual for the firm, what's unusual for the firm in the 5 risk areas. Then they would be able to adequately risk assess, each particular matter in relation to the firm-wide risk assessment. So I think absolutely they need to know what it is, know what it says, have an understanding of it. The second thing is it really depends on your processes. So I don't know if you would need to physically have the firm-wide risk assessment with you every time you're risk assessing a client or a matter. If you had, so for example, I've seen some client matter risk assessments forms that prompts the fee earner to look at, any risk associated with the client, the transaction, the work they're doing, any geographic risk, and how they'll be delivering a service to that client. Then it will be unnecessary in that situation to have a firm-wide risk assessment with you, because you don't need it, frankly. But you do have the background knowledge from training of what the firm's risk appetite is.
Yeah, I think that's a really good point around processes. So, in theory, this document is the umbrella which everything, stems from around your policies, and particularly around then how you'd individually matter risk assess. So, some firms we've seen their risk assessment has a lot of detailed information. It's wider business information. This has been fairly rare, but they wouldn't like that shared more widely within the firm. But that, as Michelle says, you then need to make sure that the conclusions of that document are filtering down, so fee earners know when they're matter risk assessing, actually our firm doesn't tolerate this risk, it's higher risk. So it's really making sure all of those things talk to each other, as you say. So another question around enhanced due diligence, or talking about how can you define it, but talking more about if we're being diligent in the first instance, is it not the case that there may be a limit to what else we can do over and above ordinary CDD? And I might sort of jump in with my bit and then welcome any thoughts from you, Michelle, sort of on this and what you're seeing on the ground. But it's a really good question, because some firms will take a sort of risk averse or approach where they want to make sure they're doing quite stringent matters on all cases. So, for example, if you're applying source of funds across the board and doing some elements of source of wealth checks, or just you're doing those additional measures that are listed as sort of where necessary, and you've set your tolerance very high, then arguably, you may already be doing enhanced due diligence across all of your files. So then it really goes to a practical point. So you may be able to justify these things that I've said are higher risk, or because of where I've set my due diligence requirements for my firm, you would be meeting the requirements in the regulations. As far as to know what steps to use, it's really tricky, because it depends on the case. You may well be able to see, do a media search, look at an accountant's document, and for one matter that could be sufficient. You could draw a line and go, yes, I'm satisfied of the risk here, this all makes sense. For other matters, it may actually become quite convoluted, and you want to see funds are genuine, where you look further behind a business, or you're checking things which can be, particularly difficult when you start looking at complex structures, or funds coming from other jurisdictions. But is there anything sort of else that you'd want to chip in there, Michelle, on that one?
I think you've covered everything, Zoe. So I agree completely. It's very difficult to be prescriptive. But if there's any circumstances where you're not satisfied with the information that you've got from a client, I think you need to keep going. You need to keep getting information until you are satisfied, and that is going to be the level of due diligence that is appropriate for that matter.
Yeah, absolutely. And there can be situations where you ask for a bank statement and that statement itself is so clear that they've got an income coming in, or dividends, that's where it stops if you are applying that higher level, which I think the person asking that question is suggesting. I mean, there is mention in Regulation 33 sort of some suggestions of what your enhanced due diligence measures may cover, if you want to have a look at that as well. So we've got a question about, do you think that an independent AML review is required for a high street firm, and how often? So this is a small to medium sized firm, and I think they're talking about independent audits. So we might both have something to say on this, but what are your initial thoughts on that, Michelle?
So we published a report, I want to say November last year, where we stated in it that we expect all firms to get an independent or to establish an independent audit function, except if you're maybe a sole practitioner. So I mean, this is a size and nature requirement. So although you're a sort of small to medium firm, you may not have to do it maybe on an annual basis. You might be able to do it, biannually, for example. But there are other things that you could also look at doing. So if you don't consider that an audit is necessary for your size, would definitely say that you need to be reviewing whether reviewing files, so be conducting file reviews. Yeah, so I'm not sure, Zoe. Is there anything else you would add to that?
Yeah, I think the start, it's how you could justify to us on your size and nature that it's not appropriate. So as Michelle says, sort of the starting point is most firms, unless you are particularly small, would require one. But some of the other factors you might want to consider in sort of justifying, where you land for your firm are things like, if you're so small that you actually have oversight of all cases and all clients, then that's fine. If you've got a structure where actually you have got other people, you've got a head of department or other people monitoring it, you start to see a structure where actually having an independent audit would be beneficial or requirement. So it's, can I justify it based on the size and nature of my work? When we talk about nature, that could be volume of regulated work, but also be mindful of the type of work you do. We know obviously conveyancing is particularly risky area to fall foul of the regulations. Another question people have asked is about this independence point. So it doesn't need to be external. So when doing an audit, the example here is talking about someone who does not work on, can it be someone within or does not work on accounts in scope, I think. So looking at people who aren't responsible for AML compliance, I'm not quite sure if that question was suggesting someone in the accounts department, potentially. So someone who can understand and apply, has the firm met these requirements and sufficiently independent from the function that sets the policies, processes around AML. I'm just going to see. Yeah, so we've had some questions about guidance on good firm-wide risk assessments and point to resources. So yes, we will be sharing a link to our guidance on this and templates, but it is something we can also take away to see if there are any further good practice that we can give in this area. From memory, some of the guidance does talk about what's good practice in these different areas. And I think that is it for questions. So thank you so much for taking the time to join us today. I do hope you found it useful. There is a link below for feedback on this webinar, and it really does help us if you can let us know what you think of the webinar and if there's anything we can improve on or other topics that you'd like us to cover. So thanks again for joining us.
Thank you.